Believe it or not, the government wants you to invest in real estate and they give you financial incentives to do so. Today, we're going to explore how and why that happens. We all know that governments around the world charge tax, and we may not like it, but they all do. We also enjoy services that they offer. When we travel overseas, we want a passport. Who pays for those passports? Well, it comes from the government. So there are really two reasons why the government charges tax. One is simply to generate revenue, and that's the one we're all familiar with. We begrudge the fact that they charge tax, but we also like the services they offer. But there's a second reason why government charge tax, and that is to shape social policy. And the simplest example I can give is they'll have a relatively high tax on things like alcohol or tobacco as a way of discouraging us from consuming too much of those things. And believe it or not, there are tremendous incentives for you to invest in real estate. Let's explore them now. The government knows that people need shelter. It's one of the fundamentals. We need food, shelter, security. And they also know that there's a certain sector in the community that's not good at providing shelter for themselves. So the government tries to step in. But they're notoriously hopeless at providing houses for the underprivileged. So they give all kinds of incentives for you, the real estate investor, to do so. We're going to explore 4 ways in which they give you a financial incentive to provide housing for the needy. The first one has to do with write-offs, and this in fact applies to any industry, not just real estate. But you can claim for taxation purposes any expenses incurred in generating taxable income. When it comes to real estate, you can deduct property taxes, insurance, maintenance, and any other legitimate expense that you incur in generating that taxable rental income. The second incentive that the government gives you is called depreciation. Now, we have depreciation on many things. For instance, if you buy an office computer or a calculator or even a car for company use, you can depreciate it on the very natural basis that in general, the value of these assets go down. And the government wants you to buy new assets so that you have modern computing technology, not that you're still using an abacus, and that you're using modern cars, not a horse-drawn carriage, which would slow industry and commerce down. However, when it comes to real estate, they also allow you to depreciate real estate. In fact, when it comes to rental residential property, they assume that it has a useful lifespan of 27.5 years, so you can depreciate it down to zero over that time span. It works out at about 2.8% a year. Or when it comes to commercial property, you can depreciate it as if it's got a useful lifespan of 39 years. But what do you think, that the government's so silly to think that properties really do go down in value and that they go to zero in 27.5 years? And the answer is no. They are smart enough to know that property values go up. Look at what's happened in the last year. On average, 17%. And in the last 2 years, nearly 28%. So why would they allow you to depreciate real estate as if it goes down in value when they know full well that it goes up in value? Well, this is what I was saying before. It's part of their incentive to encourage you to invest in real estate, to provide housing for the needy in a manner that they can't begin to do. And to do that, they give you these incentives. That is why you've always got to make sure that you claim your depreciation. And wait, it gets even better, as they say in the infomercials, because it's not just the building that you can depreciate at these rates, but there are the contents. Sometimes they're called the chattels, the fixtures, the fittings, the non-load-bearing walls, the plumbing, the wiring. You can depreciate them at a much higher rate. So whenever you buy a property, you should always engage the services of a quantity surveyor or a cost segregation person to delineate all those items in a house and work out what your total depreciation is. You'll be surprised at how much money you can get back from the government through depreciation. The next thing I want to talk about is capital gains and a capital gains tax. So if you sell a house or a property here in the United States anyway, within 1 year after purchasing it, then the capital gain is added to your ordinary income. So you're effectively paying tax on the capital gain equivalent to your marginal tax rate, which could be 37%. Long-term capital gains, or capital gains on properties you own for at least 1 year and 1 day, they're taxed at a lower rate, usually in the 15 to 20% bracket. It varies over time and it varies jurisdiction by jurisdiction. So you might say, Dolf, this video was supposed to be about incentives that the government gives you to invest in real estate, but now you're telling us that they tax you on the profit? And I'm saying, yes, they do. But here's where I perceive this as an incentive, because one of my golden rules with real estate is that you should never sell. In fact, a number of years ago, I had to modify this rule from never sell to seldom sell, because sometimes there are excruciatingly extenuating circumstances under which it might be profitable to sell a property. There might be a town whose sole industry is a coal mine, and the coal mine closes down and it employed 80% of the people. So under those circumstances, you might be wise to sell the place. But normally I would say don't sell or seldom sell. And when you've got this incentive not to sell, the government's helping my cause, because they're taxing you when you do sell in the form of a capital gains tax. So I see this as a very sensible way of discouraging you from ever selling a property, as indeed you shouldn't, because usually people who do sell a property live long enough to regret that decision. Now, talking about capital gains taxes, here in the United States, there's a thing known as a 1031 exchange. It's sometimes also called the Starker Exchange, after the person who formulated the original legislation. And talking about numbers, why is it that in the United States there are numbers to all these documents? We all fill out 1099s and 1040s and 1031s. It's a number-centric business world, I guess. But anyway, a 1031 exchange is essentially a mechanism whereby you can swap one like kind of property that you're selling for another one that you're buying, so that you do not have to pay capital gains tax on the sale of that property. You can defer the payment of that tax until you sell the property that you bought using the 1031 exchange. So it's a way of deferring. And by the way, when you sell that second property, you can do another 1031 exchange into another property, so that now you've deferred the capital gains tax that you would have paid on the first property and the second property until you sell the third property. I still believe in the notion that you'd be better off not selling the first property. Instead of selling that first property, just refinance it and use the money you pull out as a down payment to buy the second property. But that's a different topic. The fact remains that the government recognizes that this capital gains tax is a little bit onerous, and they've given you a way, if not of avoiding it, certainly of deferring it until you sell the property that you bought with the proceeds of the first. Now, there are strict rules governing this. When you sell a property, you've got a certain number of days in which you have to identify the property you're going to do the 1031 exchange into. And then there's a different number of days that you have to actually consummate the deal by for it to qualify. But if you conform to those rules, there are legal ways of avoiding the imminent payment of capital gains tax. You can defer it until a day in the future. Now, in my book, Real Estate Riches, which was on the bestseller list, the New York Times bestseller list for 7 months straight, I've got a section on all kinds of government controls and regulations and what you can do to make great profits out of investing in real estate. To get your free copy of this book, click the link and we will send you a physical copy just for the price of postage and handling. And in this book, I will share with you how you can become financially free through investing in real estate. Hopefully today you've learned something about how the government wants to incentivize you to invest in real estate. If you've liked what you've seen, remember to click the subscribe button, click the like button, and keep an eye out for my next video where I'll be showing you more tips, techniques, strategies, and methods of becoming financially free through investing in real estate.